When you look at data that comes in like it did this morning, does it really support the theory that perhaps inflation is a little hotter and may remain, and more importantly, more hot than many are expecting?
Well, thanks for having me, Shonali. I would say that, yes, it is remaining hotter. I'd say that the earlier 6 to 8 cuts that everyone's saying, I heard earlier 3 cuts, so now it's perhaps 0 to 2. And a question of timing. Remember, this is an election year, and so as you get to the November election, the Fed is not going to want to be seen as too political, and so anything they do, we believe, if they're going to do it, would be May or June, and then perhaps after the election in December. The whole key issue is we're talking about monetary and fiscal policy. Fiscal policy is quite easy, and while the Fed balance sheet has shrunk as it gone towards a stance of QT, there is still a fair amount of stimulus left over from the pandemic, and also some of the cancellation of student loans, et cetera. So there's still a lot of stimulus going on.
That stimulus, who's really still being saved by it? What parts of the market? Because I think a lot of people are still discounting what could happen once that stimulus starts to really dry up in a more meaningful way.
Well, if you look at capital markets, they are quite robust. And the only thing missing is perhaps the IPO market and equities, and some are saying they're readying those to come. So the credit markets have been quite tight. But again, there's lots of dispersion going on. So if you look at lower middle income consumers are still getting hurt. You're seeing like a McDonald's, you're seeing like a Yum Brands. They're starting to see that they can't push the pricing as they once did. So the margin compression will start to occur in some of those consumer facing companies that face the individuals. Now you're starting to see loans, all loans on the more to approaching 2008 levels. So there's some signs of some slowing. However, look at Bitcoin, look at gold, look at the equity indexes, Magnificent 7, perhaps, but there's a lot of signs of excess. So it is really a tale of two cities.
As a credit investor, how do you look at this dynamic? At the end of the day, spreads are super tight. And so do you think that people are perhaps flying away with themselves here a little bit?
If you look at the credit statistics overall leverage is large. However, again, it's all about dispersion. We're a single name credit investor. We're not playing the indexes. If you look at credit as a question of yield, and so 80% of it came from spread during the pandemic at the peaks, now only 17%. So it's a rate versus spread, and as you're right, it's indicating it's a tights, post-COVID. And so, yes, it is, some would say price to perfection. We just look at there's always opportunities in credit, long, short. The structure of credit has changed. So a lot of it is happening in ETFs, a lot of it is happening in portfolio trades or systematic trading. And so the single name market is actually quite interesting. And because the overall indexes are creating quite tight, there are a number of single names on the short side as well. And we're agnostic. We can make money long or short.
Well, I'm interested in that dynamic. How do you short a market, just like in the credit market, as you're seeing in the equity market, that is just rising across all tides here? Do you think that there's a moment of reckoning to come here that gives you more conviction to go short?
Well, it would be shorting a name. We wouldn't short a market. I think shorting the market in here, particularly on the credit side, would be at your own peril. As we go through the year, I do believe it will be slowing. You're already seeing it. Temporary staffing companies are experiencing some difficulties. However, the overall hours worked, et cetera, the composition of the labor market is still quite robust, but there's early signs. So I would say overall the economy is fine, particularly because of the election year and the fiscal stimulus that's going on. It's sort of like the foot on the gas, foot on the brake. The braking is not really having much effect because of all the stimulus that was done during the pandemic.
Well, it begs the question, do we see an economy that does break? Do you think that we fly out of this moment without having a significant downturn?
Well, I'd say it's going to be happening over quite some time. I liken it to a slow motion car crash, as I said before. I would say that we look at it as you go into year end, you'll start beginning slowing. I think it will be ultimately looked at as no landing, soft landing, progressing into a harder landing as time goes on, just because the amount of debt that is out there is just too high. And there's going to be a competition between the money that's raised by the governments and also at the corporate level. And I just think it's going to be higher for longer in terms of rates, which will ultimately prove a problem. There's a lot of refinancing that needs to go on. It's on the real estate side, on the corporate credit side. Now, you've had some refinancing gone on so far, but generally the easier credits are done then. And then as you go into, further in the credit cycle, and if new issue cranks up, as it has been doing the first couple months of the year, then investors will have a choice. They'll say, why do I own this on my portfolio? This is much more attractive. A little bit less leverage, a little bit better industry, less cyclicality, and so that will mean they'll toss out some of the more marginal credits.
Well, it begs the question for those marginal credits. You said we could potentially even see no rate cuts this year, 0 to 2, you said potentially. So in that kind of an environment, higher for longer, what do you think that means? How high for how long?
Hard to say. I'd say 430 on the 10-year at the moment. I would say you're going to maybe have 100 basis points, et cetera. That's already planned this year. I think over time it's hard to see a dramatic amount of cuts. I think the more important from our perspective is not the absolute level of rates, but what does it do to activity? And I think as you go into a supply-demand dynamic, what is the real liquidity, underlying liquidity that exists to be able to do these transactions? Real estate, again, that is something that went to very tight cap rates. A lot of issuance was done in 21 at 0 rates. Variable rate notes, those things have gone up, interest burning 2 or 3 times, debt level continue. We've been seeing a lot of opportunities on the credit risk transfer for banks, given new Basel III regulations. Also, we're seeing opportunities on these, let's call them transitional balance sheets.
Brian, how do you think about the real estate opportunity here? You've made your name in distress in so many ways. Do you think prices are bottoming enough for you to get in a bigger way?
Well, again, it's location, right? So real estate isn't known. Everything is about dispersion. Everything's about bifurcation. We all know about the commercial real estate, specifically in office. Now, if you go to the cities like San Francisco, LA, there was a transaction a couple weeks ago, 30% interest of an office building a little bit south of here that went for $1. And so, yeah, if it's $1, perhaps there's something to play. But there's always dynamics within these individual assets. In New York City, there's a number of buildings which have been leased up at quite high numbers. They're marquee assets. They'll be fine. I would say their valuations will come off the top. The problem with real estate at the moment is the transaction volume has gone down 50%, in some cases more. And so you really don't have that understanding of what is the clearing price for these assets. So while I think there's a lot of opportunities, we look at 3 ways, right? There's acquiring an asset, there's financing an asset, and there's also trading an asset. And trading an asset comes through the CMBS, RMBS, through those securities, and there's opportunities in that. We also see opportunities financing. You're getting teens, 20% in some cases, mezz in preferred. And so you're saying, okay, trophy assets, cash flow issues, I can come in and have a nice solution for this holder and make a nice return for ourselves. The acquiring, you have to be quite selective.